Okay, please come to next question number 17. We'll add some more variable in this. B Limited gave advance to C Limited for rupees 10 lakh on 1/4/2018 at interest rate of 10%. B Limited received rupees 15,000 as processing charges. Is it there? Question number 18. Yes. 17. B Limited gave on 31st March 19 loyalty bonus rupees 5,000, and as per contract B Limited is to receive rupees 10,000 on 31st March 2021 for re-verification of credit fees. So there are many cash flows involved in this problem. Okay, you will give an advance of 10 lakh, you will receive a processing fees of 15,000 on the same day. Then on 31st March 19, means after 1 year, the company will have to pay a loyalty bonus of 5,000 rupees. And as per contract, B Limited is to receive 10,000 on credit re-verification fees. This is on 31st March 2021, and the loan will be repaid by C Limited on 31st March 2022. So what you have to do? What is the question? Prepare loan account. Prepare loan account, write down. But for that we need to first check what is the nature of this instrument. FVTPL, FVTOCI, or can we follow the amortized cost? Amortized cost, because we are going to collect all the contractual cash flows associated with this instrument. Is it right? So if you have to follow amortized cost, you have to find the effective interest rate, means IRR. So first few minutes we will understand calculation of IRR. First you understand these cash flows. If you can write these cash flows properly, then only this IRR can be calculated properly. So read the question again. It says year 0, B Limited gave an advance to C Limited for rupees 10 lakh. So 10 lakh I have shown as outflow. Then it says B Limited received rupees 15,000 as processing charges. So I have shown as inflow. Then in year 1, what will happen? B Limited will receive interest from C, 10% of 10 lakh, 1 lakh. But it also says B Limited gave a loyalty bonus of 5,000. So my net cash inflow, question is from B Limited point of view, you will receive interest, pay loyalty bonus 5,000, 95,000. Year 2, there is no event except you will receive the interest of 1 lakh. In year 3, you will receive two inflows, 1 lakh for interest and 10,000 for re-verification of credit fees. And in the 4th year, you will receive 1 lakh plus 10 lakh, 11 lakh, principal plus interest. And after you've written all this, then we will calculate the IRR or EIR. So draw this format first. Use short fonts because you have to draw the ledger account also. Read question carefully. Check the cash flows. What is the interest rate on this loan? 10%. And there are some minor cash flows also in this problem, like this 15,000, this 5,000, this 10,000. So do you think your answer will be very far away from 10%? Very far away or nearby? Nearby, because there is no other major transaction. This 15,000 5,000 and this 10. These are the three extra cash flows. Otherwise, all interest and repayment is only there. Okay. So what I'll do, I'll start with 10%. And then in case if I get a positive net present value here, I will increase it by few percentage here. Or if I get negative NPV here, then I will decrease by few percentage here. No problem? Yes or no? Yes. So you start with 10% discounting factor because your interest rate itself is 10% and you have some other cash flows also. So discounting factor right first 1 upon 1.10 equal to 0.9091, 0.8264, then 0.7513, 0.6830. Is it right? ₹10 lakh, 15,000, 95,000 into 0.9091. Come on. 95,000 into 0.9091. 85,000 how much? 86,365. Very good. 82640. This is how much? 82643. Is it right? 82643. And the last one? 7 lakh 51,300. These are the cash flows and their present values. Tell me the final total minus 10 lakh also after deducting 10 lakh from all numbers. 1793. Positive or negative? Positive. Which means I will take a higher rate now. So we'll take, let's say, 15%. No problem, you can take 12, 13, 14 also. So please be little active. One upon 1.15 equal to 0.8696. Again press equal to 756. Again equal to 6575. Again equal to 5718. Okay. Multiply this 10 lakh into 1. In bracket write 10 lakh. Again 15,000 into 1. Then 95,000 into 0.8696. 82612. No problem. Come on. Next 75610. Okay. Next one. 72,325. And then last one. 6 lakh 28,980. 628,980. Check the answer. If this goes wrong, then it is a serious problem. 1 lakh 25,473. Negative. No problem. Which means my answer is between 10 and 15 only. Because if it would have been 0, that would have been the answer. 0 would be somewhere between these two numbers. So now write down EIR equal to 10 plus your NPV at 10%, 17938, upon change in NPV, 17938 plus 125 473 into change in discount rate 15 minus 10, 10.625%. Is it right? Approximately right. Ten 10.625%. Done. This is the first step. If you can't cross this step, you can't solve the problem only. So you have to calculate IRR. Now we will write down in the books of B Limited, loan to C Limited account. In the books of B Limited, for B it is a financial asset, for C it is a financial liability. So right now my topic is financial asset. Loan to C Limited. In bracket write amortized cost method. This is amortized cost method. We are going to collect all the cash flows, okay, which this asset would generate. So write down, first you write down date column 1/4, go line by line, 1/4/2018 write 1/4/2018 to bank. We gave 10 lakh rupees loan to C, and then on the same day we received processing charges. Bank to loan by bank processing charge 15,000. Is it right? First day these two entries. Then year end entry 31st March 2019. You are going to account for interest income using effective interest rate. Using effective interest rate. What is your effective interest rate? 10.625%. Multiplied by which number? 10.625% into what? 10 lakh. No, 10 lakh and minus 15,000. So my initial investment is only 9,85,000 into 9,85,000. 10466. One second. 104,656. Okay, and then there are two cash flows in this problem. We are going to pay 5,000 rupees loyalty bonus to bank. 31st March 19. Loan to bank, loyalty bonus 5,000. C Limited will pay to us 1 year interest. Bank account to loan account 1 lakh. This is what they will pay. So this I will show as cash inflow. And now dear student, tell me the balance carried down. 10 lakh plus 1,04,656 plus 5,000 minus 15,000 minus 1 lakh. Balance carried down at the end of year 1. 9 lakh 94,656. Take the total of the first year. Second year my opening balance write 1,419. Two balance brought down. Write properly. This exam is tough. There is no choice. This is opening balance. Now you try to interest income. 994,656 into 10.625%. Come on. 105,682. Buy bank 1 lakh, cash inflow 1 lakh in the form of coupon. Same date write down 31st March 2020. 31st March 2020. Buy balance carried down. Come on. 10 lakh. 338. 338. Sure, no? Because many people's life is dependent on your answer. Some people have dedicated their life to copying only. To balance brought down. Same figure, to balance brought down. And then 31st March 2021. To interest income. 1,06,000. 286. Okay, now see, in this year, keep the question in front of you. There are two payments you are going to receive from the customer, from C Limited. One is buy bank, which is your coupon, and you are also going to collect from him re-verification fees. So 31st March 2021 buy bank, re-verification fees 10,000, and 31st March 2021 buy balance carried down. Buy balance carried down. 996,624 is right. And then last year 1/4/21 996,624. You have to write the date also in the exam. All calculation. Now wait, in this year what I'll do? I will first write on the credit side 31st March 22 buy bank 11 lakh. Buy bank 11 lakh. Why 11 lakh? It's written in your table also, 1 lakh plus 10 lakh. And this interest income will become your balancing figure. How much is interest income? 10,337,6. Now, if you apply 10.625% of opening balance, how much you are getting? Just check. 10.625% of 996,624. 105891. No problem. Some difference will be there because your IRR is not 100% accurate. So take the total of fifth year, close it. Is it right? Be careful while solving the problem. Good student will go home and revise. There are so many complications involved here. You may forget to enter this bank loyalty bonus. You may forget to enter this bank or processing charges. And many students may take the interest in the beginning on 10 lakh, but it is not 10 lakh. You have a net investment of 9 lakh 85,000. Right? Have you completed question number 16? Okay, come to question number 16, which is pending for some time. This is also an important question. 16 number. Fee Limited borrows a sum of rupees 20 crore from Coffee Limited, repayable as a single bullet payment at the end of fifth year. The interest is 5%, is payable at yearly rest, means annual payment. Okay. Since the market rate is 8%, but how much interest you are charging to the other party? 5%. So that means the fair value will be different from the transaction amount, 20 crore. So what this other party is doing, it is compensating for the difference. Since market is 8%, fee limited paid an origination fee of rupees 2.4 crore. That is nothing but, after you will calculate, you will realize, is the difference between 20 crore and the present value of future cash flow discounted at 8%. So indirectly you are paying 8% only. But you are compensating the difference today in the name of origination fees. Okay. So my net cash flow in this problem will be 20 crore minus 2.4 crore only. Net outflow, investment. Is it right? Like in previous problem, I took 10 lakh minus 15,000. In this problem, it will become my net investment 20 crore minus 2.4 crore. Okay. Which is the compensation you receive towards the difference. So the difference will not transfer as expense because we received that compensation in cash immediately. Apart from the above, there are no other transaction. Show the value at which Coffee Limited would recognize the loan and the annual interest thereon. One more question from my side I have added in your notes. Prepare the loan to fee limited account. Is it right? No, homework nahi. Class work. First, we'll have to find out the fair value of the loan. In this question, they have given you the market rate is 8%. If the market rate is given to you, so that is your EIR. Using that, compute the fair value. Okay? Calculation of fair value of the loan. One of the highly tested questions in the exam. So draw this format. Year cash flow discounting factor at 8% and present value. 1-5 you can write. Because first 5 year only interest. 20 crore into 5%. How much is that 20 crore into 5%? Is it 1 crore? 1 crore. You want to write in crore, you can write all digits also. Choice is yours. And then do you compute the annuity factor at 8% and 5 year. 8% 5 year. Annuity factor. 3.9926. 27 is also welcome. Multiply. 39926 Is it right? Is it 26 or 36? Okay, 27. Make it 27. And fifth year 20 crore principal factor will be 0.6806. Is it right? Hello, first bench. 8% 5-year factor. Why you are getting annoyed? It is right. It's a time tested answer. Is it right? Take total. So you will find it comes to approximately 17.60 crore, which is exactly the difference between 20 crore and 2.4 crore. This 2.4 crore he has compensated me. I have given him discount in the interest rate. He compensated that in the form of loan origination fees. So effectively now we have given him a loan of only 17.60 crore. So write down fair value of the loan. Write down approximately 17 crore 60 lakh. I have rounded off this, which is the loan amount net of origination fees. So it is loan amount is only 17 lakh 60,000 given at 8% rate of interest. So it becomes a simple problem now, where you have lent, in form it is 20 crore, but in substance you have only lent 17.60 crore, 2 crore 40 lakh. You got the origination fees. So now we'll prepare one table, right? Amortization schedule, right? Amortization table. Or you want to pass the entry directly? You can do directly also. If you prepare this table, then preparing ledger account will become easier. Same thing you have to copy there also. Okay, write down. The question was, you are required to show the value at which Coffee Limited would recognize the loan. That I have calculated 17,60,000 and the annual interest thereon. Now for annual interest thereon, this table is required. Is it right? Draw the answer, write the answer as per the question. Question was loan amount 17.6 crore. Interest, this is the interest you will recognize. So start. Year, amortized cost opening balance, interest income recognized at 8%, interest income recognized at 8%, payment received, closing balance, amortized cost closing balance. Year 1, 2, 3, 4, 5. If you want to write in crores, lakhs, million, you manage yourself. Starting point will be 17.60 crore, that you keep in mind, not 20 crore. And then on this, we are effectively earning 8%. We are effectively earning 8%. In the form, it is 5%, but effectively it is 8%. So this 8% will go to our P&L account. This is the payment received. Next year opening balance. Calculate 8%. Payment received 1 lakh. Calculate the closing balance. Opening balance plus interest accrued minus payment received. Column number 2 plus 3 minus 4 is column number 5. Are you trying? Last year, fourth year, opening balance 8%, payment received, closing balance. It takes time, you have to be careful. There is no choice. Last year interest figure, what you do? Balancing figure. Interest figure, balancing figure 21 lakh. हो गया? Done. So if you want to write a note, otherwise write in bracket here balancing figure. Interest in the fifth year has been adjusted in accordance to the value received on closure. Any query on this? Whatever now you have written in this format will come in the ledger account also. This you have done, everybody? Now write down in the books of Coffee Limited. In the books of Coffee Limited. Loan to Fee Limited account. Loan to Fee Limited account. Draw the format first. You can write in notebook if you want. If the date is not given, then you write year 1, 2, 3, 4, 5. This is a 5-year problem. First write down on first year, first day to bank 20 crore. loan given, and by bank 2 crore 40 lakh, origination fees received. Origination fees, processing fees, whatever name they will give you, right. And then calculate the effective interest. No need to calculate again now. Keep that previous table in front of you. You have calculated this number already. Is it there? And then by bank, the collection, payment received. And by balance carried down is also calculated in that table. Tell me how much was that? One I will show you. By balance carried down. 18 crore. 18 crore 80,000. This is the answer. And second year balance brought down. 18 crore 80,000. What was the interest? 1 crore 44 lakh. 6,400. By bank is 1 crore. Is right, 1 crore. And by balance carried down. 18 crore. 44 lakh. 86,000. Is everybody checking or copying? Copying. Coughing, Good. What is interest in the third year? 1 crore 47 lakh. 58,912. By bank is 1 crore. By balance carried down. 18 crore 92 lakh. 4531. Yes. Good student will write everything. Chance takers will write something. Next year interest is how much? 151. 39,625. By bank again 1 crore. Balance 1943. 8493. Okay. And what is the interest in the last year? 15615. And payment is 21 crore. Tallied. Right. If they ask you the same question in the books of the borrower, this will reverse. Is it right? They can ask you in the books of borrower also. They can ask you in both the books also. Okay, now we will go to FVT OCI. This has some feature of FVTPL because these are measured at fair value at the end of the reporting period. So that is common. But the change in fair value will be transferred to OCI, not to P&L account. Because here the objective of holding this instrument is we can either collect the contractual cash flow. So my objective is to earn interest income also. And I can sell it also. So my objective is to earn profit by selling it also. So I am taking the market risk. I am taking the market risk here. So therefore I have to measure it at fair value. So FVT OCI. Both equity instrument and debt instrument can be classified as FVT OCI. Now answer, when will debt instrument be classified as FVT OCI? Debt instrument, investment in debenture bond, when it will be classified as FVT OCI? When the contractual cash flow test is satisfied, it generates cash flows which represents solely the payment of principal and interest. And second, the objective to hold this instrument is to either sell it or receive the contractual cash flow. When will an equity instrument be designated as FVT OCI? If the management wants to designate it and it is not held for trading purpose. It's not held for trading and management voluntarily chooses the FVT OCI as an option. Okay. Yes or no? There is no voice only. What happened? A financial instrument or asset shall be measured at FVT OCI if both the following conditions are met. The asset is held in a business model. Now you need to make a small improvement in the answer. A debt financial asset should be measured at FVT OCI if the following conditions are met. The asset is held in a business model in which the assets are managed both in order to collect contractual cash flow and for sale, and the contractual terms of financial asset give rise on specified dates to cash flows that are solely payment of principal and interest. The two conditions are satisfied, then a debt instrument will be FVT OCI. And now, when will an equity instrument be designated as FVT OCI? When the management makes an irrevocable election. Okay. An entity may make an irrevocable election to present in OCI income subsequent changes in value of an investment in equity instrument, underline that is not held for trading. Up to this also, if you understand, it is good enough, but some more complication which right now is not important, nor contingent consideration recognized by an acquirer in a business combination to which IFRS 3 business combination applies. So this you will learn in business combination. Contingent consideration, the election is made on an instrument by instrument basis. It is not necessary that all equity instruments have to be designated as FVT OCI. So I can choose. Okay. So I have investment in shares of Walmart Limited. Example only. I have investment in shares of Google. Okay. And I am also investor in Apple. Example only. So I can choose this as FVT OCI. And I can choose this as FVT OCI. And I will not choose this as an FVT OCI. So it will become FVT PL. So instrument by instrument, you can apply the choice. So the summary of our discussion till now, two types of financial assets are measured at FVT OCI. One is equity, which is designated by the management under this category, and second is debt instrument, which meets the two conditions. Okay. Accounting of equity instrument which are measured at FVT OCI. Same like FVTPL instrument, but this time the difference will be transferred to OCI. Investment in particular equity instrument that may irrevocably be designated at initial recognition as at FVT OCI. Now here one mistake we can make. What about the dividend income that you will receive on this equity instrument, which you have designated as FVT OCI? Dividend income will be recognized in, as usual, profit and dividend is not a change in fair value. So dividend income will be recognized in P&L account with all other gains and losses, including those related to foreign exchange, will be recognized in OCI. Now, if it is equity instrument measured at OCI, subsequently, even if the instrument is derecognized, it will not be reclassified to P&L account. The balance in OCI will be transferred to other equity account. Within equity, there will be a movement from OCI to maybe reserve and surplus, general reserve, but it will not be routed through P&L account. This is for equity instrument. These gains and losses remain permanently in equity and are not subsequently transferred to P&L account even on derecognition. So in OCI, there are two types of items. in IS1 you have learned. Those which are subsequently transferred to P&L account and those which are not subsequently transferred to P&L account. So it belongs to that second category, which is recognized in OCI but not subsequently taken to P&L account. It will be transferred to other component of equity. Now see the scheme of journal entries that we need to pass in case if it is FVT OCI equity instrument. FVT OCI equity instrument, then I am going to give you a scheme of journal entry for FVT OCI debt instrument also, right? Scheme of entries, if you understand, you understood the accounts. Rest all is formality. Is it right? All presentation, disclosure is just a formality. What you need to understand is the scheme of entries. This is what we have to punch in the computer. Rest all the software will take care. Is it right? So first on initial recognition, note is printed, financial asset account debit to bank. At what amount? Fair value. And if you have paid any transaction cost, that also you add to the financial asset because it is FVT OCI now. So then you pass entry for increase in fair value, financial asset to OCI, decrease in fair value, OCI to financial asset. On sale or realization, right now my topic is not derecognition but to complete the sequence of entries, bank account debit, P&L account debit to financial asset and to OCI write down. Except dividend income, all gain and losses will be routed through OCI. Huh? This both. And then once the instrument is derecognized, transfer of OCI to other component of equity, OCI account debit to other equity. Is it right? But if there is dividend income received, which I have not written here, then that will be transferred to profit and loss account. Now we'll see the application of theory. This is a question number 18. Solution is given. So only understand. And then 19 where solution is not given. Okay. Change kar do. X Limited invested in equity share on 2nd September 2014. The transaction price of the share was rupees 100 million. And there was a transaction cost of 0.05 million. Now what will you do with this transaction cost depends on what is the classification you choose. It made an irrevocable election to classify the investment as at FVT OCI. So what about this transaction cost? You will add to this 100. So your year 0 day investment will be 100.05. Is it right? Then at the year end, the fair value of the investment is 102 million. So from 100.05, it has gone to 102 million. Okay. So increase or decrease? Increase. Increase by how much? 1.95. Is it right? 1.95? Yeah, 1.5. 1.95. If the investments were sold at the year end, now this is to confuse you. If the investments were sold at year end it would have incurred a transaction cost of rupees 0.06 million. This is the transaction cost at the end. Now, in some standards, like for example, standard on impairment, we calculate fair value less cost to sell. Or for example, IFRS 5, non-current asset held for sale is valued at lower of the two, carrying amount, fair value less cost to sell. This standard does not say like this. It says the instrument will be valued at fair value. So ignore this transaction cost. This is a hypothetical number. If we would have sold the investment, then we would have incurred a transaction cost. Okay, you have to ignore it. Should the fair value at the end of the year be 102 million minus transaction cost of 0.06 million? And the next question is, how should the fair value change be accounted for? These are such minute details which the student has to know. Okay. So in this standard, we have never spoken even once fair value less cost to sell. I have always spoken fair value at the end of the year. So what will be your answer? At subsequent measurement, fair value of the financial asset is not computed. Underline not computed. Net of cost to sell. Fair value less cost to sell concept is used in some other standard. Like for example, standard on impairment. Then standard on non-current asset held for sale and discontinued operation. Then the answer should be the fair value at the end of the year will be shown as 102 million. What about the accounting treatment? The standard says the change in fair value, that is 102 minus 100.05 equal to 1.95, will be shown in S statement of other comprehensive income, and we will accumulate in a separate component of equity. You can give it a name called fair value reserve. Fair value at initial measurement will be transaction price plus directly attributable transaction cost. Why we are adding transaction cost? Because it is FVT OCI, which normally we want to hold it for long term, but we can also sell it. Is it right? One more simple question. Number 19. On 1st April 2020, ASF Limited bought 1000 equity share of B Limited at rupees 35. Stamp duty of rupees 0.50 per share and commission on purchase at rupees 0.30 per share. Oh, we have seen this problem earlier also. But the second line is different. Equity shares are to be valued at, or equity shares are to be measured at FVT OCI. The same problem I took as FVT PL also. And you will see the difference in the accounting. Closing balance is 35 rupees per share. Show journal entries and carrying value in SOFP and SOPL. Will you pass the same entries or different entries this time? This time I am going to value investment in the beginning at 30 rupees, add on your calculator, plus 0.50 plus 0.30, 30.80 into 1000. Directly the transaction cost also I will add in the investment. So my entry number 1 will be investment in equity share FVT OCI account debit. Are you getting 30,800? To bank account 30,800. And to help you, I have written the working note also. 1000 into 30 you paid for the share, and 1000 into 0.80 you paid for the transaction cost. Transaction cost is included in the carrying amount of investment now. And then at the end of the year, the value of the investment is 35 rupees. So my value of investment will be 1000 into 35. Is it right? 35,000. And the carrying amount is 30,800. Check. What is the change in the fair value? 4,200. Investment in equity share account debit to fair value reserve account OCI. So it will be shown in OCI and it will be shown in the statement of changes in equity also. Okay. This was about equity instrument. The previous two example was on equity instrument. What about debt instrument? But first you show the presentation in statement of comprehensive income. Write down there in your notebook, in your book, other comprehensive income, fair value gain on investment in share. How much you have written? 4,200. And in balance sheet, non-current asset. If equity instrument is FVT OCI category, normally it is for a long term strategic investment. Then you put it in non-current asset, financial asset, investment in equity share of B Limited, 35,000 will appear. Right? Paragraph 23. Debt instrument measured at FVT OCI. Debt instrument measured at FVT OCI. We have already learnt when will you classify it as FVT OCI. Now see the accounting treatment. Change in fair value should be recognized in OCI except the interest calculated, underline, using the effective interest rate method. Interest will be calculated using the effective interest rate method. Effective interest rate method means again you will draw the amortization schedule like we did in this coffee and fee problem. Before that also 3-4 questions. Amortization schedule and whatever interest earned you have calculated in that third column will be the income you are going to recognize in the FVT OCI debt instrument. Is it right? So if it is a debt instrument, first you will have to prepare one amortization schedule. Compute the effective interest there. That table figure will be transferred to the account. Okay. And at the end of the year, you have to also value it at fair value. So you are actually mixing the two concepts, fair value concept also and effective interest rate concept also. So effective interest rate as per the amortization table, fair value as per the end of the year, and if your account doesn't tally, again the difference will be transferred to OCI. Foreign exchange gain and loss will be transferred to P&L account here in this case of debt instrument. An impairment gain or loss on debt instrument, P&L account. Only the change in fair value will be routed through OCI and until the financial asset is derecognized or reclassified. Now let us see the scheme of journal entries carefully, and in case if there is any printing error, typing error, you let me know. Is it there in your notes also? First entry on day 1, financial asset account debit to bank, in bracket write include transaction cost also, right? Include transaction cost also. Then year end interest income to be recognized using effective interest rate. Entry will be financial asset account debit to interest income, and for that we have to first prepare that amortization table. Why I made you practice 5 or 6 questions? Because you will have to use the same table in FVT OCI debt instrument also. Okay. And then in case if you receive any interest, bank account debit to financial asset, like we did in the amortized cost category. But these 3 entries look similar to amortized cost entry, but there is an extra calculation we have to do. Change in fair value will pass one entry, financial asset to OCI or OCI to financial asset. On sale or realization will pass the entry, bank account debit to P&L account in case of debt instrument. OCI to P&L account you have to transfer again in debt instrument. Okay. In case of debt instrument classified as OCI, we transfer the balance to P&L account. In case of equity instrument classified as FVT OCI, we do not transfer to P&L account. Is it right? So here, even if you transfer to OCI, it will get transferred to P&L account, to financial asset to P&L account, and then you transfer the balance to P&L account. See the last entry. So that is why in the sixth entry only I have written P&L account, because my objective is to sell also, huh? And I am going to transfer the OCI to P&L account. So if you write OCI, no problem. Again, in the last entry, that figure will get transferred to P&L account. Now we'll solve one question. Okay, simple question. Format is also there. Just do the fill in the blanks work. On 1st April 2021, write down the name of investor. A Limited bought 6%, 1000 bonds of ABC at 85. So it's a bond, means debt instrument, which is maturing on 31st March 26. So how many years? 5 or 6? 5. This is April to March. Okay. Market rate is 89. That is fair value at the end of the year 1. The financial asset is held to achieve an objective of both collecting contractual cash flow and selling the financial asset. So what is the objective of giving this sentence to you in the question? Classification will be FVT OCI. Right? Show the journal entries. And effective rate of interest is 9.95%. If you do the calculation, it will come to 9.95%. You want to try, or you will trust me? Trust me. Okay. This is 6%, but it is issued at a heavy discount. So therefore your effective return is higher than 6%. Okay. Bonds issued at a discount will have a higher effective interest rate than the coupon rate. So first, what you will do in such problem, whether it is amortized cost instrument or FVT OCI debt instrument, prepare the amortization schedule for recognition of interest income. Start. Year 1. Opening balance. Draw the table. I have drawn the table for you. You have to complete it. 85,000 is right. 85 into 1000. Tell me, is it right? 8458. First year 8458. Interest received, that you write down 6,000, 6,000, 6,000 5 times. Okay. Then next year, tell me, is the opening balance 87458? Don't copy, but I have not checked the calculation. You have to tell me, is the interest 8702? Closing balance, is it 90160? Right? 90160. Third year, 90160, 8970, 6,000, 93130. Check. Is it right? Don't get tired. Still miles to go. Fourth year, anybody closing balance? Fourth year. Is it 96397 or 96398? Anybody last year? 1 lakh. We have to reach 1 lakh. So this will become the balancing figure. In such question, assume face value per bond is rupees 100. Face value per bond, assume 100 rupees. So after 5 years, the balance in that bond account as per this amortization schedule will be 1 lakh. Okay. Now we will pass journal entry for first year only. Sir, why not second year? Because they have not given the fair value of second, third, fourth, and fifth year. Is it right? But in all the 5 year, just for understanding, while writing the interest entry, you will take interest income from this table. Fair value will be given to you, and then balancing figure transferred to OCI. Is it right? Don't calculate interest on opening balance, because opening balance is fair value. Opening balance will be fair value, but for interest calculation I have to take effective interest. So that is based on this table. Okay. So okay, journal entries write down. Day 1, 1st April 2021, investment account debit to bank account. Investment account debit to bank account 85,000. 85,000. Narration also, if you want to write narration? No. Okay, don't write. Remember, being the 6% bonds classified as FVT OCI security. Okay. This way you have to write some minor narration. Then you will pass entry for interest received. Bank account debit 6,000 to investment account 6,000. Bank to investment account 6,000. Tell me 2 more entries. Have you accounted for interest earned? No. So what is the interest earned in the first year as per that amortization table? 8458. Okay, so write that entry which I have not written. Investment account debit to interest income 8458. Why I have not written? Investment account debit to interest income 8458. Right. Now we have to pass one last entry for fair value. Is it right? What is the fair value of the instrument at the end of the year? 89. So we have to keep the balance of 89 into 1000, 89,000, and remaining amount I will transfer to OCI. Is it right? Now suppose this is my investment account. I have written so far following entries. Please tell me the numbers. To bank 85,000. Then by bank I have written 6,000. To interest income I have written, I am preparing a ledger. You said how much? 8458. This is what I have written so far in this account. And the balance that I need to carry forward is 89,000. This is the first year ledger account. Therefore, the balancing figure, which side you have balancing figure? Debit side. This side? Tell me the balance. 15. This side or credit side? Debit side. So you will write down 2 OCI. Fair value reserve. You can give some name to this. But suppose they ask you to pass journal entry, then you have to see what is my closing fair value and what is my book value. So my book value is 85,000 plus 8458 minus 6,000. So this is my book value. So it seems my book value needs to be increased. So it will be an unrealized gain. which will be transferred to OCI. Okay, so to OCI, fair value gain. Fair value gain. So this is the ledger account also I have drawn in the first year. Is it right? Now just dear student, please understand, next year opening balance you will write 89,000. Interest income you will take from amortization table. And buy bank you will write 6,000. Buy balance carried down, again the fair value at the end of year 2. And again the difference you transfer to OCI. Is it right? Yes or no? Now you write down the presentation in statement of comprehensive income. In statement of comprehensive income, in first part, that is the P&L account part, in other income, interest income will appear. Other income, interest income will appear. Interest will come in P&L account. Fair value change will come in OCI. 1542. Is right? And what about the balance sheet? So write down those who have done. Statement of financial position, asset side. As on 31st March 2022, in bracket write extract. So asset side, non-current asset, financial asset, investment account, bonds, FVT, OCI. And what will be the balance now? 89,000. And suppose you want to write the equity side also. So P&L account, income 8460, okay, 8458, and other comprehensive income 1542. This answer is over. Now we'll continue tomorrow.